Albert Einstein marveled at its power, calling compound interest the greatest mathematical discovery of all time. But what makes it so potent? Today we're going to explore how this force transforms modest savings into substantial wealth over time. Simply put, compound interest works like this. When you invest money, it earns interest. Then rather than taking that interest out, you leave it in your investment account, and now you're earning interest on both your original money and the interest that has already been gained. Now as time passes, this cycle repeats, and each time on a larger sum of money than before, your wealth expands faster and faster because it's making money, earnings on the earnings, returns on the returns. And it's faster than you might imagine. So let's consider this practical example. Let's say a couple starts saving at age 20. They only need $540 a month to amass a real value of $1 million. I'll break that down. So real value meaning in today's dollars by age 60. So if they have 40 years and let's say they're getting an 8% annual rate of return, they will get in today's dollar terms $1 million by the time that they are 60 years old. So that's factoring in a 2.2% inflation rate. So in 40 years, $2.2 million will give you $1 million in spending power today. So if you delay the start, so if we have another couple and they delay the start and they don't start saving till they're 30, you'll need double that amount on a monthly basis. So you'll need $1,048 a month with the same metrics to hit $1 million in today's dollar terms by age 40. Now, what if you wait until you're 40 to start saving? That quadruples. It's now $2,234 a month. And at 50, it soars to a rate of over $6,000 each month. So I put together a projection using financial planning software where I tried to answer the question, what if you were 20 years old and all you did, the only thing you did was you opened a tax-free savings account today and you only contributed the annual contribution limit increases that the government allows. So for example, what if you only contributed $7,000 this year, which is the annual contribution increase amount, and then you kept contributing the new limit each year, which goes up by inflation, and it's kind of rounded to the nearest $500, so it's going up each year. Well, by the time that this 20-year-old was 60 years old, they would have $1.933 million, which when paired with the average CPP, or Canada Pension Plan benefits, or old age security benefits, this would provide them with a retirement income of $150,000 per year, all the way to age 90. They could fund a 30-year retirement just with their tax-free savings account and never pay tax on any of the gains. Now, I'm going to share with you a little known fact. Getting that first $100,000 of invested capital is the toughest leg of this race to $1 million, but it's the most important. And that's because of the time it takes to make subsequent $100,000 increments gets shorter and shorter due to this absolute miracle of compound interest. Charlie Munger, the right-hand man of Warren Buffett, who recently passed away with a net worth of over $2.3 billion, had a famous quote where he says that first $100,000 is the hardest to get, but you got to do it. In fact, he said, your first $100,000 is the toughest to earn, but it's the most crucial for building wealth. And he stresses getting to $100,000 by any legal means possible is so important because your net worth completely explodes after that first $100,000. And this is due to a few core principles that we're talking about today in today's videos. So the first is that capital increases proportionally as the amount of capital itself increases. This is where, people start to say, it takes money to make money. Or you're making money while you sleep. So I would say that the second principle here is that as you stack your money on the first 100,000, it's like a snowball going downhill. As the snowball travels downward, it gets bigger and bigger because it accumulates more snow as the snowball gets larger and it gets a larger surface area. It works exactly like that here. Let's give an example. So if you saved $10,000 a year and you were able to get a 7% rate of return on your investment in the stock market, which typically returns 8 to 10%, but you're paying taxes on that, there might be some fees, etc. So let's say it's 7%. And To get to your first $100,000, it takes you 7.84 years. But if you continue to save $10,000 a year, and you now have $100,000 working for you as well, the next $100,000 comes much, much quicker. In fact, it's about 5.1 years. So take a look at this graph, and what you're seeing here is that each subsequent $100,000 increment that you earn gets faster and faster because you have this initial capital invested or sitting there earning returns while you're continuing to contribute to the account. So let's look at that path to the first $500,000. Well, if you looked at the first 100,000 was 7.84 years, the second 100,000 was 5.1 years, well then it's 3.78 years, then the next 100,000 after that's 3.01 years. So essentially by the time you're getting to that, between 4 and 500,000, you're down to 2.5 years to get that amount. And this gets faster and faster. In fact, if you break it down, what's interesting is that of the total 30 years that it takes you to accumulate this $1 million, 75% of the time happened after that first 100,000. So in other words, 25% of the time was that earning that first 10% of the money and getting that there. I shouldn't say earning, but contributing and investing and getting to that first $100,000. That first $100,000 is extremely important because each $100,000 comes faster and faster, and it's like that snowball that rolls, accumulates more, and then it actually picks up speed over time. Look, if you saved $15,000 a year for 6 years, even if you only attained a return of 4.5%, you would hit that $100,000, you'd hit about $105,000 after 6 years. But 85% of that would have been comprised of your own savings, and 15% would be earnings on what you contributed. So in another example, let's say that you save $10,000 per year, but you average 10%, a 10% rate of return. Well, in 7 years, that's what it would take you to get to that first $100,000, but only 67% would be comprised of your contributions, and the remainder of the return, about a third of it, would be from the gains that you got on there. So investment returns really make a big difference, but the biggest difference you can make is getting to that first $100,000.